Hello, hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 58. I'm Charlie Bilello, and with me, as always, Peter Mallouk. Peter, today we're going to touch on all of the hot topics going on. Rate cuts, recessions, and we're going to end with risk. So let's start out with the rate cuts. As you know, the Fed's been on hold all year long, kind of fighting the pressures from the White House, from pretty much everyone saying the Fed needs to cut rates. They're behind the curve. I actually thought they were right in holding rates, but we'll leave that out of this equation. As you know, last year, 100 basis points were cut in the last few months of the year. And now, next week, they're expecting those rate cuts to resume. The Fed is expected to cut 25 basis points, maybe a little chance of 50. As you know, last year, right before the meeting, it shifted to 50. So we'll see. There's a big inflation print coming out tomorrow. So that might change the odds for sure. But pretty much a done deal that they're going to cut rates. And really the question is going to be, Peter, from there, what are their dot plot projections for the remainder of the year and for next year? And what the market is betting is this is going to set off a wave of easing. 3 cuts now priced in for this year and 3 more in 2026, which would bring the Fed funds rate back below 3%. What do you make of the expectations? Are you on board? This is a done deal for next week. And do you think the Fed is potentially making a policy mistake, or do you think this is the right move?
Well, I do think it's a done deal for next week. I mean, pricing 90% in, that's usually a very accurate prediction, and so almost certain to happen. But I think when you look at the dot plot of expectations, I mean, historically, this has been wildly wrong. I think it is a fascinating chart for me because the one we're using is Fed funds futures. But even when you look at the Federal Reserve itself, and the governors there laying out their predictions of what's going to happen, they are historically wrong. And as you and I know, and everyone knows, it's because the economy is so dynamic. There's just too many things coming in that can change things. But in general, I mean, this rate cut's going to happen. And I think the market basically thinks we're heading into a much softer economy. So it's basically saying, hey, tariffs are going to make things cost more. And we're also going to have unemployment, which we saw uptick considerably. There's expectations that unemployment will continue to uptick, mostly because of softening economy. And if you look out more to the future, because of AI, and then you have massive pressure from President Trump to lower rates. You put all those things together. Yeah, I think in the short run, we're going to see lower rates. In the long run, while the market leans that way, I'm not convinced. I mean, in general, despite all the things that we've talked about, unemployment's still historically low, and the economy is still historically strong. And you kind of have to go out of our way to mess this up. So it'll be interesting to see how it plays out.
So let's talk about that balance of risk here that the Fed has. As everyone knows, there's 2 mandates: maximum employment and price stability. And they've been focusing more on the price stability end of things for much of this year. But this was the line in the Jackson Hole speech, Peter, that got markets very excited. The S&P immediately shot up about 2% after he said this. The balance of risks appears to be shifting. And what he essentially was saying there, this is Jerome Powell speaking, he's saying that, yes, inflation is going up. And this is actually an interesting position that the Fed's in, because inflation's at the highest point of the year. They're likely to get another hot CPI print tomorrow. I'm expecting that. But they're saying this rise in unemployment, 4.3%, highest we've seen in a few years, that now takes over as their primary concern, enough to where the balance should be to ease in their opinion. And as you said, still very low, right? The historical average is 5.7%. We're at 4.3%. But in their minds, I think they're suggesting or projecting that the unemployment rate is likely to continue to rise, and they have to get ahead of that. So it's a tough position, obviously, to be in. You have inflation, you have employment, you're trying to do both of these things. And my question would be, Peter, is if the Fed cuts 25 basis points or cuts a few times, is that necessarily actually going to help with the unemployment picture? If someone is not hiring someone today, if you cut interest rates 25 basis points and they don't need to hire someone, or they are all of a sudden going to do that, or are they just going to take that money to their bottom line, let's say if they're saving money on financing costs?
Well, I think it's incremental. I think there's no question if you look at the number one employer in the country is are small businesses and small and mid-sized businesses. And, see, and then there's all kinds of private businesses that have revenues of 25 million and up, and many of them have debt. And the cost of debt takes a lot of their cash flow. And if you lower the cost of their debt, they have more cash flow. What do they do with more cash flow? Most businesses invest in equipment and they invest in expansion and they hire people. Now, does 25 bips like magically do something that changes everything? No, I would equate it to like homeowners. We don't see a lot of people buying homes because they don't want to leave their low mortgage rate and go into a very substantially higher rate. Does 25 basis points suddenly make people go buy homes that couldn't afford the monthly payment before or leave their lower rate to go to the higher rate? No, the 25 doesn't, but it starts to soften, right? And then the next 25, the next, and these things become incremental and then they make a difference. And the Fed historically doesn't make very sharp moves because they don't want to dictate the economy, right? They want to gently, gently move towards things, basically make a change, measure, see how the economy reacts, and so on. So to your point, to your question, 25 bips by itself, no. Over time, incrementally, definitely yes. Extremely impactful on the economy.
Do you think they're sending the message if they do indeed cut next week, and it seems highly likely they will? Do you think they're sending their message that, yeah, we have a 2% inflation target, but do we really adhere to that? Not really if they're going to cut as we're approaching 3%. Do you think they're sending that message to the
I mean,
markets?
that's a great point, Charlie, because I think what's unique about this time is historically the Fed raises rates a lot, lowers rates a lot in response to things that require dramatic action. 08, 09, COVID, 9/11, tech bubble, things like that. What we're seeing here, and I don't recall it ever happening while I've been paying attention to things, actually seeing higher inflation, an uptick in inflation, and inflationary policy, right? Moving out of the country a lot of workers and having tariffs, things like this, right? You have inflationary policy and you actually see an uptick in inflation and then have the Fed guide to lower rates. That is new, right? That's very fascinating. And as I don't know if it's a function of political pressure, if it's a function of expected really big drop off of the economy. Um, is it a function of the national debt has become unsustainable? We need lower borrowing costs. I don't know which of these things is really carrying the day here the most, but it is new and unique.
Yeah, my take is just simply the Fed, like politicians, and I know they're not supposed to be acting like that, they want to get the credit of easing policy. And there's more of a benefit from bias towards easing than there is a bias towards tightening. And so, all else equal, yeah, people don't like inflation, but they never really made the connection between the Fed's actions in 2020 and 2021 and what happened with inflation. And so they're running the risk here saying, hey, if they didn't figure it out then, they're probably not going to figure it out now, which is another way of saying, Peter, as you've often said, the Fed likes to say they don't want inflation, but they're pretty much telling you we want it. It's just how much of it do we want? And this is to me saying we're going to tolerate 3%. Will they tolerate 4%? I don't know, but definitely that 2% target, throw it out the window. They're willing to tolerate it because the pain of saying to people, we're not going to cut interest rates, holding the line there in terms of inflation. Well, how many people other than me are saying you should do that? Really, because it's only helping the bottom tier of workers, right? Everyone else wants those rate cuts because they have assets and they want that inflation because asset prices tend to go up when you have this easy money policy.
Yeah, it's, completely agree.
So the rates cuts are coming, regardless of
Yeah.
how you and I feel about it. And there's going to be inflation. And we'll see what happens in terms of their posture, in terms of how they react to these inflation prints. I don't think they're going to be using the term transitory again, Peter. But to me,
Yeah.
that's kind of what they're
Yeah.
saying. Like this rise of inflation is transitory, which of course, everything's transitory if you go long enough. But to me,
Mhm.
this is sending a bad message in terms of inflation. Okay, but here's the big question, Peter, that a lot of people are talking about, because you and I covered in the last episode the housing market. It's been frozen for a few years, and the hope is that if you cut interest rates, similar to hope last year, mortgage rates will go down. That will help unfreeze the lockup effect. People will start listing more. There will be more people transacting in the housing market. But that didn't really happen last year as expected, right? So the Fed starts cutting rates last September. They cut rates by 1%. We have a higher mortgage rate today than we did back then. And this is getting into the weeds a little bit. But the reason for that is the Fed is cutting short term interest rates. And as of now, they're not engaging in quantitative easing anymore. They're letting their balance sheet run off very slowly. And so that longer term yield is more tied to longer term inflation expectations. That's actually higher today than back then. So what do you make of this situation? We could see the Fed cut now a few more times this year, and the mortgage rate, yeah, all else equal, it should go down a little bit, but it might not go down as much as people think it will.
Yeah, I mean, what we're seeing here is private markets don't believe that inflation is going to be under control and that long-term rates can stay low. It just doesn't believe it. And so, until we see real economic weakness, I don't think we'll see mortgage rates follow proportionately. What's your take, Charlie?
Yeah, that's a good point. Yeah, it unless the Fed goes out and actively tries to engage in, and I think eventually that's where this is headed. They'll first stop the quantitative tightening, and then they'll because there's going to be pressure, Peter, saying like, yeah, you're cutting short-term interest rates, but on the long end it's not coming down enough, so you have to go out and actively buy it like you did the last time. So yeah, I think for many reasons that's where eventually headed, but clearly you're right in terms of this. If you let the free market determine these longer term rates, well, the free market's saying we're engaging in a lot of inflationary policies here, and we're not buying these long term bonds with this higher expected inflation.
Yeah.
So it'll be interesting to see how it all plays out, but it's not necessarily one for one. Now, if they cut rates to zero, for sure you're going to see this rate come down, but just 25 basis points here, we don't know, right? Because if that rate cut leads to higher inflation or higher inflation expectations, the long end could go up like it did last year. Let's shift to the second section here. Recessions, Peter, always a big question, obviously not as big as a few months ago, but I really want to dig into the labor market data we've been getting of late. The expansion now is 5 years old, and there's nothing to suggest, as we've talked about, that that means it has to end. It could go on 10 years. We've seen that before. It could go on even longer, but we're seeing a shift in the labor market, and clearly this is what the Fed is going to highlight next week. We're seeing now more unemployed people in the US than there are job openings. So this is just gradually cooling of the labor market. And this is an indicator that in the past 50 years, Peter, has pretty much preceded most, if not all, recessions in the US, where job growth year over year is now below 1%. And we got these massive revisions, the biggest revisions in history yesterday, in terms of saying there wasn't as much job creation as we thought previously. So that would bring this number down even more. And then at the same time, we have this situation, and I want your take on this, where youth unemployment, so the younger workers, people graduating college, trying to find that first job, well, we're seeing the biggest disparity we've seen in this in over a decade. If you exclude the COVID period, 9.4% unemployment rate for 20 to 24-year-olds versus 4.3% overall. I threw a lot at you there, but what's your take? You talk to a lot of business owners in terms of hiring and the labor market. Do you have an opinion here on, is this softening potentially an indicator of more than just AI, and there's some economic weakness there potentially ahead as well?
I think there's a lot going on here. I think if we say we had normal world before COVID, when we came out of COVID, there was so much money poured into the system. It's really hard for anyone to comprehend. I mean, trillions and trillions of dollars. So just imagine, you're coming out of your house, you've saved up all this money because you're getting your paycheck because of all of these loans and stuff the government's doing. You can't spend it. So you have all this money, plus you've received a forgivable loan or a bailout or a stimulus check. trillions and trillions of dollars. Just imagine it dropped from the sky. People picked it up, took it in their house, and then COVID's over, and everyone can come out with all this money and spend. And I think some of our listeners will remember going to restaurants and sections were closed. So more people are going to restaurants than ever, but the restaurants couldn't keep up with them because they didn't have enough employees. Demand was through the roof. Everyone was going out to eat. Everyone was getting on a plane. Everyone was spending like crazy. You couldn't buy anything. I mean, everything was just selling out everywhere. And I know some of my clients, at least three I can think of, began to employ people with special needs to work in their restaurants and places like that. And so it gives you an idea like how hard it was to find talent, that they were, hiring people that were taking much longer to get the same amount of work done. That's how tight the market was. Well, we're finally seeing the money ease through this system. We got a long way to go, but we're Americans. We blow our money pretty fast. And so a lot of it has started to subside, and we're starting to see some normalcy return, some normal demand instead of incredibly intense demand, and the supply is finally catching up. And so I mean, like I can just tell you, 3-4 years ago, everyone was hiring everybody they could possibly, everybody out of college, no experience, don't know what you're doing. The major's not relevant. So what? We'll figure it out. That is over, right? We're not even back to the real world yet, but that part is over. And I see that's the trend. That's the trend. I don't even think AI is baked into these numbers. I think that's coming and that's going to change the game big time, but it's not there yet.
Yeah, so we've had this decline, right? Job openings, 12 million hit a record high right after that COVID. Right? As you said, it was extremely hard to fill many, many roles. And now we're in balance. Like this is just a much more normal labor market. But my big question, Peter, and I don't know if you're hearing any of this or just anecdotally, I'm hearing more of this in terms of is is this indicative of something more? This youth unemployment rising here. It's not. I wouldn't say it's alarming yet, but is this indicative where companies at the start they simply say, "Well, we'll slow down on the new hiring, and we'll, the new class that's coming in. Perhaps we can fill some of this with AI technology, or perhaps the existing employees will do more." But is that at some point that filter into the rest of the company in terms of, well, they start saying, well, let's take a look at the next level of employee, and do we, is this something? Are you hearing it yet? And maybe you're not hearing it yet, but this is the concern that I'm hearing a lot in the last few months about this.
Well, I think that we're not even back to pre-COVID levels of U.S. unemployment for 2024. So I don't think that that we're at alarming levels here yet.
Yep.
I think alarming levels are coming. I think the AI part is coming, and when that comes, it is going to be, I think, shocking to people. And I think we're going to see it across professions that people they think they're immune, and the first jobs that are going to get replaced are the people with the least specialized technical skills or the least very high uh, EQ skills, let's call them. And that's a lot of people coming right out of college, right? And so I think we're going to see this number spike in the coming years.
Okay. So let's go to the signal or noise question here, Peter. And this is a tough one because every time I looked at every economic cycle since the 1940s, and every time the unemployment rate has risen this much, we're about 0.9% up from the cycle low, which was 3.4%. Every time in the past it has risen that much, we've seen a recession already occurring. Like the economy was already in a recession, or in 2020, you were just at the start of the recession. So really the question is, Peter, is this a signal once again, or for the first time, is it just noise? And I'll give you three reasons why. You're never supposed to say this time is different, but is it different because of AI and tax stimulus that we had this year and the continued deficit spending? Does that counteract what we've seen in the past?
This is why it's so hard to predict the future, because you want to go, well, obviously, it's happened all these times, it's going to happen again. But I don't think anyone doubts, no matter how cynical they are, that AI is going to make the world much more efficient, right? Everyone knows we're going to need less people and things are going to be faster and it's going to drive profitability. The only question is how much, how much, how much. We always know the government was willing to do deficit spending, but we're in a world now that is like incomprehensible to anybody, even 7, 8 years ago, no one would have dreamed that this kind of spending could happen. $1 trillion every 80 days. I mean, how do you how do you get your brain around what that means for the economy in the short run and the terrible consequences for the economy in the long run? So you're right. These are really, really big things. Can you have a recession with trillions of dollars dropping from the sky and people having tax cuts and AI making everything more efficient? I think the answer is yes. But look, nobody knows. I'm not going to make a prediction here because I don't know better than anybody else. But there are some major, major factors. The biggest technological advancement in all of mankind, tax cuts into a strong economy, and deficit spending that's incomprehensibly high. Can those shield short term suffering, a short term recession? Maybe it is different this time. It's weird to say those words out loud. We'll see. I don't think it impacts the way an investor should think about things because there's just too much uncertainty. But it's going to be interesting to see how it plays out. What's your take?
Yeah, I think it's incredibly complicated, but you can't look at this and not clearly say glaringly we're looking at very different situation. If you look at AI, and this is really a question of what inning you think we're in, and no one really knows that, but we know we're in the early stages in terms of the impact of AI. But the big question, Peter, in terms of the economy is this massive increase in capex spending from the biggest players. Is that going to continue? There's no looking at the guidance in the last quarter, there's no indication that they're going to slow down anytime soon. And I know that can change and that could shift on a dime, but that's a massive trend that's definitely going to help economic growth as long as that continues. And then in terms of the job losses with AI, it's going to take time. As you said, the unemployment is still pretty low here. It's going to take time, I guess, before it would have to rise to, let's say, 6, 7% before you start saying, well, now we have so much unemployment from AI that people aren't spending as much, and it's causing economic weakness in that area, and that's counteracting the profitability gains that companies are getting. So it's a very weird situation because we have these corporations clearly making massive amount of profits, getting more and more efficient. If you look at their margins, Peter, almost at record high for these big tech companies. And so that's a massive tailwind to say perhaps this time is different. And then I look at just the deficit spending, right? When have you had an economic slowdown when you're borrowing and spending this much money, throwing additional money? Usually, if you're 5 years into expansion, Peter, at some point people say, oh, let's pull back here. Let's start to get prudent. That, as you know, that didn't happen. We just continue to do it, and then we talk about the debt ceiling that was lifted during the big beautiful bill lifted by 5 trillion, and we're already 1 trillion into that, and it's only been 2 months. So all of these things would suggest, yes, this time is different. Is it enough to say there'll never be a recession again? Of course not. But I think it makes it much harder to see a traditional type of downturn with all these factors. Is that how you're thinking about it?
Yeah, that's exactly how I think. I mean, it's certainly not going to be a standard downturn, but with all these factors, it's just it's going to be fascinating to see how the next 3, 4 quarters play out.
Yeah. And in terms of just getting back to the last question on the youth unemployment thing, and I'm sure people have asked you this, you're advising someone who's going off to college now in terms of what should I major in, what should I focus on with this labor market becoming more difficult and potentially jobs being eliminated by the. Do you have advice? Have you given advice to people on that front?
My feeling here is the more of a broad education you can get, the kind of a go anywhere education, the better. Like, I don't know that it helps the world to have another business major. I'm a business major. My wife is, my kids are, but it's flexible. Do you know what I mean? Like,
Yeah.
wherever you can go, wherever you need to go. Whereas if you get something very specific and say software engineering today, and you get specialized in there and AI comes in and takes out that specialization, it's a little more dangerous. So I think the world has really favored that kind of specialization, and now it's become a little more dangerous in the last couple of years.
Yeah, adaptability, flexibility is going to be much more important going forward than in the past for sure. Okay, let's go to the last section here on risk. And This might surprise a lot of people, but maybe not. The S&P 500, Peter, has now quadrupled in the last 10 years in terms of its total return, including dividends. That's close to 15% per year over the last decade. And if you ask people what the S&P did the prior decade, they probably couldn't tell you, but I'm going to tell you here, 93%, so 6.8% per year. Of course, we had the global financial crisis, took some time to dig out of that period. And then if we look at the 10 years before that, 155%, 9.8% per year. There you had the big boom in the 90s, then the dot-com bubble crash, and then you clawed your way out of that. So every 10 years is different. But in terms of investor expectations today, because this is where we are, it would be impossible to say that investors aren't thinking this is likely to continue. And the only way you can really say that for sure is to look at valuations, right? And so if we look at something like the CAPE ratio, are investors thinking this is going to continue? Yes. Why? We're seeing the highest CAPE ratio, 39, since 2000. And really, it becomes a question now of, do you think AI will lead to that hyper growth in earnings, or do you think expectations are too high? I don't know the answers to any of that, Peter. All I know is historically, there's more risk when people are crazily optimistic as they seem to be today. And it seems to be justified, a lot of that optimism, but there tends to be more risk. And we don't know when that risk is going to appear, but the highest valuations tend to have the worst future returns, which should make sense. And the cheapest valuations tend to have the best future returns. To me, this is the biggest risk for investors with so many positive things going on. It's simply, are they too optimistic about the future? And the counter to that, Peter, which I want your take on, is we have this revolutionary technology. Perhaps valuations don't matter anymore, and perhaps we're going to pass the dot-com bubble peak in terms of valuations. We're going to blow past 44. Maybe we go to 50, 60, 70 in terms of the capers. That's what people are telling me. That I just want to present the counter argument to this.
Well, I think valuations always matter. I don't think there's ever a time where valuations don't matter. I do think it's a little different here in that when you look at the internet bubble, you had 100 companies that had no earnings, right, driving a lot of the valuation. Here, if you take out the top 5, 10 companies out of the S&P 500, you don't have the same valuation gap. And then when we go look at those 5, 10 companies, we have the AI revolution happening there, and we know that's going to drive tremendous earnings, and that it's kind of hard to even predict what the ceiling is, where it may even be. So there's real earnings backing this up now. And I think that is very, very different. And the overvaluation is concentrated in that part of it. I think these valuations are not sustainable and they have to come down, and they'll come down when the earnings start to show signs of slowing. And that's going to be inevitable. And the question's when, and will it be steep or will it not be steep? The market doesn't have to go down 30% to fix this. I mean, earnings can decelerate at a less, just decelerate, and that's enough. And so I think that's the difference. Is the S&P 500 itself is not 480, 490 of those stocks are not tremendously overvalued, historically speaking. And the ones that are, they're real earnings. They have momentum. They're expanding. And we really can't tell what the ceiling is. But there is always a ceiling, right? There always is one. The market will eventually find it. And there will be a great unwind, as there always is.
So trees don't grow to the sky, as as the expression is. But I guess in terms of what an investor should take away from this, Peter, and we've said it over the past few years, but is it the same or similar takeaway as back in 2000? Make sure you're diversified across asset classes, across geography, across style. Make sure you're involved in asset classes that don't necessarily look like the Mag 7 names in terms of
Yeah.
valuations.
Yeah, don't have all your eggs in one basket is a recurring message here, and this is a good time to make sure you don't have all your eggs in one basket.
All right, good message. Peter, great show today. Everyone, thanks for joining us. Want to remind everyone we're doing these Connect events around the country. 4 more to go this year, so join us. The next one's in Denver at the end of September. Then we got Atlanta, Tampa, and Miami, Fort Lauderdale. So we'll have a link in the show notes. Hope to see you at this event. And Peter and I will do the Signal or Noise podcast for you live there. So definitely hope to see you there. And we'll be doing a whole host of more cities in 2026. And we'll release that to you soon and hope to see you at that as well. So thanks everyone for joining us today. If you're watching this on YouTube, just a reminder, hit that subscribe button for all the latest content from us, and we'll see you next time on Signal or Noise.